This is the 16th installment to the series entitled Build Your Business into an Asset of Value. Give me 6 hours to chop down a tree and I will spend the first 4 sharpening the axe. The most important first step to secure capital for your business's needs is to learn about the available sources of funding. Don't go into the world of business finance ignorantly. It will cost you, perhaps even cost you your business. This book is about helping you to develop the skills you need to build your business into an asset of value. A big part of the skills you require is to understand where and how your business can access capital to fund its needs. In this chapter, I address funding for trading activities and more specifically for the cost of sales, which includes cost of inventory, procurement costs, trade finance costs, and insurance. Supplier credit. A good friend runs an electrical contractor business. He provides services to a wide range of individuals and corporate customers. To fulfill the terms of some of the major contracts that he routinely secures, his business needs to procure high-value electrical components. Over the years, he has developed such a good relationship with his major suppliers that they offer him trade terms, allowing him to pay for the consignment of goods 30 days after delivery. His customers in turn pay him almost immediately. The result is that he often gets paid by his clients before he must pay his suppliers. He does not run a multi-million rand business. He has a limited staff complement of about 22 trained and skilled technicians. His business has not been in existence for decades. I'm sharing this with you because I want you to understand that securing trade terms with suppliers is in no way reserved for large businesses. Supplier credit is the best way for a business to fund its trading activities. Nothing beats this. What strategies can you employ to enhance the prospects of your business securing trade terms with suppliers? Firstly, be a good payer. It goes without saying that suppliers will only consider extending payment terms to customers that pay their invoices in full and on time. Volumes. Move a lot of stock for the supplier. Suppliers, just like your business, want to increase sales. I understand that you may not want to be dependent on 1 or 2 suppliers, and as a result you endeavor to diversify your supplier base to reduce risk. But there is an argument to be made for limiting your supplier base. Only when your business consistently moves substantial volumes of stock for the supplier will the supplier consider extending trade terms to you. Protect their reputation. One of the major risks for any business is misrepresentation by distributors. Treat your suppliers' products as though your own. Do everything you can to present your suppliers' products in a way that protects their reputation. Make your supplier feel like your business is an extension of theirs. Integrate your procurement processes. Suppliers, just like you, want information about future demand for their products. By integrating your procurement processes, which are in turn informed by your sales processes and forecast, with your suppliers, you can provide valuable information about future demand. Not only will you avoid potential delays in supply, but suppliers will perceive your business as a valuable partner. Share market information. Successful businesses are constantly researching the market. Share relevant information with suppliers, and they will want to engage with you and your business. A business loan. Don't be confused or intimidated by fancy terminology bandied about by financiers, including cash flow finance, inventory finance, stock finance, same-day finance. Marketers aim to differentiate their products by attaching fancy terms. Your job as business owner is to get past all the hype and understand the mechanics of any finance solution so that you can make an informed decision. Most of these finance solutions are in fact an unsecured business loan. Unsecured since no asset serves as collateral for the debt. However, financiers will almost always insist that the directors of the business accept personal responsibility for the loan by way of a personal surety. This type of financing solution provides a limited amount of capital or loan value, typically over a short loan term of a few weeks or months, and is offered at very high rates of finance. Financiers operating in this space are increasingly making use of artificial intelligence to evaluate the financial performance of businesses. Often the only documentation required is the bank statements of the applying businesses over 12 months, where a system calculates cash flows. Much can be gleaned from bank statements, including the value and regularity of cash inflows, payments received from customers or cash deposits, the value and regularity of cash outflows to suppliers and service providers, red flags including dishonored payments and intermittent cash flow deficits, and the value and regularity of money transfers amongst business owners and other related entities. Nothing is more important to these financiers than a healthy cash flow. Although an argument can be made to make use of unsecured business loans to fund trading activities, you should really be doing all you can to move your business away from using this type of financing solution. The finance cost is too high, the amount of capital that you can feasibly access too limited, and the process of applying and securing finance too onerous, despite all the marketing messages from these financiers. Trade finance solutions. Banks and certain specialist financiers offer trade finance solutions. Some of these trade financiers are generalists, and others specialize in specific industries and even products. Trade financiers often offer comprehensive and very valuable ancillary services, including advice on and facilitation of importing and exporting of products, international payments, including the use of trade finance instruments like letters of credit, insurance of stock, and protection against adverse currency movements, which is important to international trade. For the purpose of this chapter, I limit the discussion to purchase order finance and invoice discounting. Purchase order finance. This type of finance solution provides funding for a specific invoice or purchase order. There are 4 parties involved in the transaction: the borrower, that is the business requiring funding; the supplier, that is the business that supplies the consignment or product; the buyer, that is the end user or buyer of the consignment or product; and the trade financier, that is the financier funding the transaction. How this works. The financier agrees to pay the supplier on behalf of the borrower after the buyer issues a purchase order for the consignment or product. The buyer pays the financier for the consignment or product, not the borrower. The financier subtracts their finance costs from the payments received from the buyer and pay the net value to the borrower. Advantages. The borrower needs no capital to fund the deal. and the borrower secures a deal that would otherwise be out of reach. Disadvantages: the borrower's profits are reduced by the finance charges. Finance charges for this type of solution is typically high, and the buyer must consent to the arrangement. Furthermore, trade financiers will typically only offer purchase order finance for finished products. That is a product that require no assembly. Financiers avoid transactions that include raw materials or components and will typically not fund any labor associated cost to the buyer. Secondly, financiers want to deal with reputable suppliers. Financiers can only demand payment from the buyer if the supplier delivers the correct product or consignment. Consequently, financiers will only do business with reputable suppliers. Reputable buyers. Financiers typically only consider purchase order finance where the buyer is a listed or a well-known corporate entity with a strong reputation for honoring its obligations. Due to the high incidence of corruption amongst state-owned entities, financiers typically shy away from deals involving government or government-owned entities. There are some notable exceptions to this rule. Purchase order finance is a great way for a small business to fund high-value orders from reputable buyers. But this solution comes at a high finance cost and should only be used on an ad hoc basis. Next, we come to invoice discounting, where purchase order finance is an ad hoc finance solution. Invoice discounting is a more permanent arrangement or means of funding trading activities. Three parties are involved in the transaction or arrangement. The borrower, that is the business requiring funding. The buyer, that is the end user or buyer of the consignment of product. The only difference here is that invoice discounting usually applies to multiple transactions with a debtor's book or a group of buyers, whereas purchase order finance always applies to a specific transaction only. And lastly, the trade financier, that is the financier funding the transaction. How this works. The financier assesses the financial viability of the debtor's book or buyers that regularly purchase product from the borrower. If the buyers are reputable, the financier will consider providing funding to the borrower by advancing a portion, usually a percentage of the invoice value. That is the invoice issued by the buyer to the borrower. The financier expresses the value of the advanced funding at a discount rate. Example, a financier ascribes a discount rate of 80% to a buyer. That means that when the borrower secures an invoice from that buyer to the value of 100,000 Rand, the financier will provide advanced funding of 80% of 100,000 Rand or 80,000 Rand to the borrower. But the financier will limit the overall facility value of the funding. For example, the total facility value is given as 1 million Rand with an 80% discount rate applicable to specified buyers. The financier will often insist on segregating the debtor's book by way of a separate bank account where buyer payments are received. Advantages. Funding is provided to the borrower based on the strength or value of buyer invoices. The borrower can use funding for any purpose. The funding does not have to be used for any specific order. The borrower has confidence to trade with bigger buyers since the total facility value is known beforehand. Similarly, the borrower can order larger consignments of stock from suppliers and in doing so negotiate better prices, bringing procurement costs down. Disadvantages: the borrower's profits are reduced by the finance charges. A trade finance facility may impede existing credit lines with other financiers. The process of applying and securing the funding facility is costly and burdensome, and the buyer or buyers must consent to the arrangement. In conclusion, a strategy of organic growth is often appropriate for a business in the early stages where supplier and buyer relationships are still being developed and the business manager are still coming to terms with a new trading environment. Using cash reserves to grow the business makes sense, and if the opportunity arises, making use of a business loan or purchase order finance to capitalize on an opportunity is a good idea. But where an entrepreneur aspires to attract external investors, a slow and steady growth strategy will not do. Investors seek opportunities where growth can be accelerated over the medium term, where the value of their investment in the business appreciates considerably over a few years. Accelerating growth often depends on using external sources of funding and more sophisticated sources of funding, including invoice discounting. Thank you for watching. To access the full series, visit Constructum Online Learning on YouTube or click on the link in the post.